Welcome to Venture Capital Demystified, Module 3, Episode 3 of the Starting a Company series. Many founders approach VCs without truly understanding the VC business model. We'll change that today. This program is brought to you by the Series of Thoughts team. This video is part of a larger course called Starting Your Company, which covers validating your idea, legal foundations, funding your company, building your business, building your team, and growth and scale. This episode focuses on the third topic in the Funding Your Company module, understanding the world of venture capital and how to navigate it. We'll then cover pre-seed funding, venture capital, non-dilutive options, and building a winning pitch deck. By the end of this video, you will understand how VC funds operate, what drives investor decisions, and how to read a term sheet. We will cover the math behind VC, the stages of a deal, a term sheet walkthrough, and what no really means. Chapter 1. How VC math works. To effectively pitch a VC, you need to grasp their business model and why the underlying math dictates certain investment decisions. A VC firm raises money from limited partners, or LPs, who are often pension funds and wealthy individuals. This capital is pooled into a fund and deployed into startups over a 3 to 5 year period. The fund size determines the check size a VC can write. Funds range from micro/pre-seed at $10 million, $50 million, writing $250,000, $1 million checks, to growth funds at $500 million plus, writing $20 million, $100 million plus checks. Know who you are pitching to. The 10x rule means a $100 million fund must return $300 million plus to LPs. Out of 20 to 30 investments, only 1 or 2 companies need to return the entire fund, demanding a path to a $1 billion plus outcome. VCs need billion-dollar markets for the math to work. To justify a $500 million plus exit valuation, a company needs a meaningful share of a market worth at least $1 to $5 billion. Market size is critical for a fund returning outcome. Understand the different types of VCs. Seed funds invest early with high risk tolerance. Series A funds seek repeatable growth signals. Growth funds focus on execution and proven models. Corporate VCs mix financial and strategic goals. Chapter 2. What VCs actually look for. This is often not what first-time founders expect, and it's almost never the product itself. VCs evaluate every deal through a consistent lens, the investor decision framework. The weight given to the 3 key factors is clear, and the rankings are often surprising. The 50/30/20ths framework breaks down investor focus, 50% team, 30% market, and 20% traction. VCs bet on people and markets first, believing a great team in a great market will build the right product. Team comes first. In early-stage investing, the product will change. VCs bet on the team's ability to learn, pivot, hire, and lead. They look for domain expertise, strong co-founder relationships, and clear communication. Market timing is the hidden variable. VCs spend time assessing if the timing is right. Look for secular tailwinds like regulatory shifts or technological unlocks, incumbent weakness, and clear customer readiness. Chapter 3. Stages of a VC deal. We will now walk through exactly what happens inside a real fundraising process, from the first email to wired funds. The 6 stages of a VC deal include the intro meeting for initial fit, the pitch deck for review of vision and metrics, the partner meeting with decision makers, and the term sheet offering key deal terms. Each stage has a specific purpose. Stages 1 and 2 cover the introduction and the pitch. Warm intros convert at 30 to 40%, while cold outreach is less than 1%. The goal of the first pitch is to earn a second meeting by presenting a crisp problem statement, your unique insight, and why now is the right moment. Stage 3 is the partner meeting, the most important meeting. Your job is to present a confident vision and withstand probing questions from all investment partners. Prepare for deep dives on market size, unit economics, and team background. Stage 4 is the term sheet. This is a non-binding letter of intent that outlines key economic and governance terms. It triggers a period of exclusivity for due diligence. Critically, never sign a term sheet without specialized legal counsel, as the terms follow you through future rounds. Stages 5 and 6 involve due diligence and closing. Due diligence is 2 to 6 weeks of verifying claims on financials, cap table, and legal history. Be proactively transparent, as surprises kill deals. Closing is 1 to 3 weeks of finalizing documents and wiring funds, typically costing $15,000 to $30,000 in legal fees. Chapter 4. Term Sheet Anatomy. The terms you agree to in your first round will shape every round that follows. It's crucial to know exactly what you are signing. Here are 6 key terms every founder must understand. We'll cover valuation, liquidation preference, anti-dilution, pro rata rights, board seats, and information rights. These terms determine founder equity and control. Valuation is explained by the formula. Post-money valuation equals pre-money valuation plus investment amount. This determines the investor's ownership and your dilution. Since safes now default to post-money caps, model your cap table carefully before signing. Liquidation preference is critical for non-home run outcomes. 1x non-participating is standard and founder-friendly. 1x participating reduces founder upside significantly, and 2x or higher is a major red flag at the seed stage. Anti-dilution protects investors during a quote down round when you raise at a lower price per share. Broad-based weighted average is standard and reasonable. Full ratchet is aggressive and should be avoided due to potential catastrophic dilution. Board composition is a consequential decision. A typical seed board is 2 founder seats and 1 investor seat, retaining founder control. Watch out for investor majority at an early stage, as this can severely restrict your decision-making ability. Chapter 5 focuses on founder-friendly versus investor-friendly terms. Not all term sheets are created equal. You need to know what is standard and what to fight for. Knowing what to push back on is crucial. VCs expect negotiation, and being informed signals confidence. Focus on which terms are aggressive deviations from standard market practice. This chart provides a side-by-side comparison of founder-friendly versus investor-friendly terms, allowing you to easily identify and negotiate the most favorable terms for your company. The option pool size is an overlooked dilution trap. VCs often require a large option pool to be created before investment, which dilutes founders. Negotiate the option pool size to reflect only what's needed for the next 12 to 18 months of hiring. Protective provisions give investors blocking rights on company actions. Standard provisions, like blocking the sale of the company, are acceptable. Overreaching provisions, such as blocking hiring or budgets, turn investors into operators and should be pushed back on. Chapter 6: What no really means. Most founders misread rejections, often overinterpreting or underinterpreting what a VC pass actually signals. VCs constantly pass on investments, sometimes missing out on future unicorns. A pass is not a judgment on your worth as a founder, but it contains valuable information if you know how to decode it. A pass usually means a stage mismatch. The company is too early or late for the fund's mandate. Other common reasons are portfolio conflict, market conviction gap, or fund cycle timing. These are structural, not quality issues. Founders often catastrophize rejections, but a pass almost never means your idea is bad or you're a poor founder. It is often a reflection of the investor's model, timing, or fit, and it is not permanent. After a pass, generic rejections are useless. Ask this specific question to get useful feedback. If there's one thing that, if different, would have made this a fit for your fund, would you be willing to share it? Chapter 7: Red flags to watch for. Not every investor who wants to give you money is one you should take money from. You must watch out for misaligned partners. Be wary of investors who seek excessive control early. The best VCs know their job is to support the founder, not run the company. Demanding majority board control or approval over operational decisions at the seed stage is a major red flag. 3 red flags should stop you cold: unusual liquidation preferences above 1x non-participating, rushed timelines with artificial urgency, and resistance to providing founder references. These signal misalignment and potential issues. Do your due diligence on your investor, as this person may be on your board for years. Ask other founders about the VC's behavior in hard moments, and ask the VC directly about their fund's capital status and typical involvement. The best VC relationships are partnerships built on genuine alignment. Avoid the adversarial framework. Great VCs offer pattern recognition, network density, and support, especially when things are hard. Here is an episode summary of the VC playbook at a glance. Understanding how VCs think and what drives their decisions transforms your interactions from pitching to having a strategic conversation. Our key takeaways are: know the VC's business model, pitch team and market first, read every term sheet with an attorney, and due diligence on your investors.